Hey everyone, and welcome to All Things BDC by Refinitiv LPC. My name is Fran Byers. I'm the head of market analysis for middle market and direct lending loans at LPC.
My name is David Brooke. I'm a senior correspondent covering leveraged loan and private credit market at Refinitiv LPC.
And my name is Andrew Headland. I too am a correspondent that focuses on middle market, the fundraising and private credit news at Refinitiv LPC.
So today we're going to dive into some of the key themes over the second quarter. While the first quarter was all about massive markdowns and dividend cuts in light of the nationwide shutdown from COVID-19, 2Q was a bit more upbeat. BDCs have shown us that the worst is behind them as the US economy continues to open up. While originations were down drastically, management teams signaled they're optimistic for more M&A in the back half of the year. And we saw that BDCs were able to mark up their performing credits. However, many continue to see a pickup in defaulted loans. Almost every call centered around amendment activity, and there was a lot of commentary from managers on how they plan to boost portfolio yields moving forward in light of lower LIBOR and a weaker M&A environment. Lastly, on this videocast today, we're going to discuss with you how the consolidation trend pre-COVID continues today. And we'll end on perhaps some good news for the BDCs from the SEC. So starting with the reversal of markdowns, you can see here on the left that secondary bid levels have been rebounding across the leveraged loan market. And when coupled with a spread tightening environment on the new issue front, it's allowed the BDC managers to mark back up most of their performing loans. So after seeing a record 14% drop in NAV per share in 1Q20, NAV per share rebounded about 3% in 2Q20. However, we're not yet back to where we were pre-COVID. This chart shows you the average mark on BDC's portfolios. And you can see in yellow that while the average mark today of 92% is better than 1Q20's 90%, it's still lower than the 4Q19's 95% average. And while 3/4 of the BDC universe did grow NAV per share at 2Q20, we still had about a quarter of the universe show additional declines. In fact, we tracked over 80 issuers with loans that were marked down more than 10 points in 2Q20 across the universe, with many being in the energy, manufacturing, and retail sectors.
The second quarter was the first full quarter that portfolio companies had to deal with the COVID-19 fallout, also meaning an entire period for lenders and borrowers to address financial difficulties that businesses may have been having. The BDCs appeared largely accommodating to their borrowers and were doing so in a prudent way through which they can extract concessions out of the borrower. On its earnings call, Golub Capital BDC referred to the more than 50 modifications it made in its portfolio as, quote, credit enhancing because the fund has been able to garner pricing increases, better documentation, or procure additional equity investments from the private equity sponsor. Ares Capital Corp noted a similar dynamic. And from the 8 material amendments Owl Rock made, the fund was able to garner an average of 120 basis points of incremental spread on those investments. The increased economics on underlying portfolios is going to be a key driver for BDCs to meet dividend yields. LIBOR has fallen drastically, and fee generation will be lower due to a slower M&A environment, both of which will be a drag on net investment income. About 6% to 10% of BDC portfolios had material modifications or amendments, according to Refinitiv LPC data. Average BDC portfolio company leverage was also up slightly from the first quarter.
One of the areas of the BDC market that appears to be sort of waving the coronavirus storm a bit better is the BDC's targeting venture lending and ABLs. And that is perhaps helped by the life sciences market, which has been in very robust shape. A high focus on vaccination is focusing a lot of capital in that direction. And this, remember, is a sector highly sought after in the VC space. And VC funds are arriving back on raising record amounts in the last couple of years. So have the money to spend, and it seems to be a safe bet. Now, with non-essential services coming back to normal, that can only continue to grow. Speaking of lenders in the space and on the calls, venture loans did widen in pricing and documentation was tighter, but has now reverted to pre-COVID norms. Because VC loans generate double-digit returns, a lot of competition is between equity and debt providers. A sponsor has to think whether the cheaper debt option is worth being subordinate in a capital structure. So you can see in the slide, BDCs specializing in this space have fared better, greater NAV stability. You can see here on the chart that relative to all the other public BDCs in this space, most managers that focus on venture and life sciences lending showed fewer names trading below 85% in both the first and second quarter of this year. NAVs have grown in some instances and remain lowly levered compared to the traditional cash flow lending BDCs. Hercules, the largest venture lender BDC, said it would prioritize less risky credits, even if it means lower yields. On the more broader ABL front, Solar reported an improvement in its portfolio. ABLs historically have had a higher recovery rate, and the BDC said that is a trend that is set to continue. This was also helped with a number of portfolio companies able to secure government aid money.
So just to summarize credit quality quickly, while most BDCs have shown credit quality improvement across their portfolios, the weaker names in the COVID impacted sectors are still getting weaker. The non-accrual rate rose to 6% in 2Q20 from 5.7% in 1Q20. We tracked about 70 new names that were added to non-accrual status across both the public and private universe. And when we look at the new loans in default for the first half of the year and we annualize that figure, we calculate an approximate 8% default rate for 2020. Now, to fortify their balance sheets and protect themselves against having too much exposure to bank credit facilities, we have seen a slew of BDCs take advantage of the favorable unsecured bond market conditions. Blackstone GSO, Barings, and Crescent Capital all received first-time investment grade ratings earlier this summer. And those BDCs that tapped the bond market in July and August saw more favorable pricing economics relative to those that issued during the height of the pandemic back in April and May. Already $5.5 billion in unsecured bond issuance has hit the market this year.
And with several BDCs struggling with portfolio issues, another big question that we heard analysts ask managers on earnings calls was if consolidation in the BDC space would ramp up. One of the bigger pieces of news to come out of this earnings season is Barings BDC's purchase of MVC Capital. It'll be a cash and stock transaction worth $177.5 million, which comes out to be $10.04 book price. One of the novel aspects of this transaction is Barings guaranteeing $23 million in credit losses on the MVC portfolio, which may be a first of its kind provision. Raymond James analyst Robert Dodd explained it well. If the shareholders get the upside if the MVC loan book is undervalued, but the manager pays the shareholders if the assets in the aggregate were undervalued, were valued on the higher side. It's only one of many consolidations that have happened this year. BC Partners managed Portman Ridge Finance announced in June that it would merge with Garrison. In February, First Eagle closed its acquisition of THL, and Crescent Capital BDC purchased Alcentra Capital Corp.
And in the quarter, it looked like there's been some good news for BDCs from the SEC, as the SEC announced that it might be potentially relaxing rules on the dreaded acquired fund fees and expenses disclosure requirements, or AFFE. To recap, the AFFE was introduced in 2006 as a way to protect retail investors and requires mutual funds to provide the expenses of the funds, BDCs, as a separate line item. Key to this is protecting against pyramiding, funds investing in other funds and so on, and collecting fees on top. But in 2014, the Russell, S&P, and MSCI indexes all kicked the BDCs off its platform, citing the AFFE, resulting in depressed share prices and less liquidity entering the market. So you can see where the BDCs want this gone. Lawmakers are pushing for it, and now the SEC appears to be listening and a consultation is underway. However, this is not a total removal of AFFE requirements for mutual funds. The AFFE would not be necessary if 10% of the mutual funds or less are invested in other funds. On the surface, this is a good thing. I spoke to Brett Palmer, President of SBIA, who said the SEC had recognized this problem and called this a positive step. But is it enough to get BDCs back on those indexes? Some analysts, including Robert Dodd at Raymond James, isn't so sure. So this could only be a smaller step than the one first hoped for.
Thank you once again, David and Andrew, for your amazing coverage, and thanks to everyone for listening. If you wish to stay on top of our middle market news and analytics, you can follow all of us on Twitter. Also, Refinitiv LPC is hosting a 2-day virtual loan conference on September 15th and 16th. It is free to join, and the link is listed here for you to register. Stay safe, and we hope you will join us in the fall.